Welcome back to the deep dive. This is where we crack open some dense financial sources and really distill them into pure, memorable knowledge.
That's the goal.
And today, we are taking a very, very specific journey. We're looking at the capital that fuels real estate investment.
Specifically, hard money lending.
Exactly. But we're not just, defining the term. We are grounding this geographically right in the middle of the high-stakes, fast-moving market of San Diego.
Yeah, that's spot on. Our mission for you today is to go way beyond the basics.
Right.
The goal is for you, the investor, to really get the intricate mechanics, the specialized programs, and, the specific terms that these local asset-based lenders are offering.
The ones who only deal with real estate pros.
Exactly. We're looking for the how and the why. Why are these tools engineered this way? It's all about maximizing an investor's profit in a place like San Diego.
Okay, so let's unpack that foundational concept first. We hear hard money all the time. But if someone is only familiar with their traditional bank, how is HML fundamentally different?
Hard money lending, HML, is at its core, it's asset-based lending. And that is the key distinction.
Okay, asset thing.
Traditional banks, they focus so intensely on the borrower, your credit history, your W-2s, all this paperwork.
A mountain of it.
HML just shifts that focus entirely. They're looking squarely at the property's value now and, critically, its potential value after you renovate it.
So the asset itself.
The asset itself, not the borrower's, personal financial baggage. And that focus is what allows for the speed and flexibility that a bank just can't match.
And speed. I mean, speed is often the single most valuable currency in real estate, especially when you're competing for a deal.
It is.
If a distressed property hits the market, you just can't wait 45 days for a loan underwriter to finish looking at your tax returns.
You can't. And that's exactly why HML exists.
Yeah.
It's transactional capital. It's designed for pure velocity.
So what's the number?
Our sources highlight this one fantastic statistic here that really defines the edge, the average closing time.
For these specific lenders in San Diego?
Yeah, it's just 14 days.
Wow, 2 weeks.
2 weeks from application to funding. And that ability to move fast, that translates directly into you securing deals that other investors are going to miss.
A 14-day close is absolute magic when you're facing multiple offers. But that speed usually comes with a higher price tag.
It can, yeah.
Which leads us right into what they're actually lending for. It seems like it's not just one generic product. They've built like a whole menu of loans for an investor's specific goal.
Exactly. They've aligned the capital to the strategy.
Okay.
The foundational product everyone knows is the fix and flip loan.
Right, the classic.
Pure project velocity capital. It funds the purchase and the renovation of a distressed property, and it's all aimed at a fast, profitable sale.
But the offerings for the long-term investors, that's where I think we see the real sophistication. These are the programs that let you scale a rental portfolio without your personal finances slowing you down.
This is where we need to define a few critical acronyms. So the first major wealth-building product is the DSCR loan. It stands for Debt Service Coverage Ratio. And the key difference is how you qualify. The lender does not look at your personal tax returns.
Okay, so what do they look at?
The property's corrected cash flow, the DSCR. If the rent you expect to get covers the mortgage payment with a little cushion, you qualify. Simple as that.
So if I'm an investor, maybe I own 10 rental properties and my personal tax returns look complicated.
Right.
Because of tax deductions and so on. A traditional bank might just panic and say no.
They often do.
But the DSCR loan just says, show us the lease.
Exactly. Show us the asset can pay for itself. It lets sophisticated investors keep growing without having to unwind their whole financial life.
And speaking of complicated finances.
Well, that brings us to the next product line. It's aimed squarely at the self-employed investor who always faces the most scrutiny.
The dreaded tax return analysis.
Right. So enter the bank statement loan.
Yeah.
This program is tailored for those people who, they struggle to show a huge taxable income,
Right.
but they have tremendous cash flow. So instead of tax returns, the investor can qualify using your bank deposits. It's proof of reliable income. It just recognizes the reality of being an entrepreneur today.
That is a complete game changer for so many investors. Okay, and then as you build that portfolio, you move beyond single-family homes.
Naturally. Which is why you find multifamily loans on the menu. They're designed to finance duplexes, apartment buildings, anything to scale up that cash flow.
And what about timing? Sometimes you just need money to bridge a gap.
Can't forget timing capital. They offer bridge loans, which are short-term solutions to help you, say, quickly secure a property while you're waiting for your long-term financing to come through.
And for the really big projects.
There are ground-up construction loans or GUC loans. They'll fund the entire thing from buying the land right through to the final build.
That is a very comprehensive menu. So now that we know what they lend for, let's get into the structure that decides how much they'll lend and at what price.
The investor loyalty ladder.
I love that name. It's this transparent, quantitative system where your experience is directly tied to your costs.
This is where you see that the lender is underwriting the investor's track record just as much as the property. It's a structured reward system.
Okay, so we need to break down these four borrower tiers, but let's not just talk rates. Let's talk about the LTV, the loan to value.
Crucial.
Put it in practical terms for us. Let's say a $600,000 property in San Diego. What does this LTV difference actually cost an investor?
Okay, good example. Let's start with bronze tier. This is your entry level. You've only done 1 or 2 deals.
The newcomer.
The newcomer. You face a 10% LTV reduction, so your max LTV is 80%. On that $600,000 house, that means a max loan of $480,000. You have to bring $120,000 in cash.
And your rates are the highest.
Highest rates, from 12.99% to 13.49%.
Okay, so that 10% LTV reduction, the difference between 90% and 80%, that means you're forced to leave an extra $60,000 of your own cash stuck in that one deal.
Precisely the point.
Yeah.
It limits how many projects you can take on. Now, move up to silver tier. You've done 3 to 4 deals. Your LTV reduction drops to 5%, so you can get up to 85% LTV.
So on that same house.
On the $600,000 house, you can borrow $510,000. You only need $90,000 down. You just save $30,000 in cash compared to bronze. And your rates get a bit better, 11.99% to 12.49%.
So just by finishing a couple more deals, you get to put 33% less cash into the same property. That's significant, but where do the real perks kick in?
The serious shift is at the gold tier, 5 to 9 deals. And crucially, there is no LTV reduction.
So you get the full 90%.
The full 90% LTV. You can borrow $540,000. That's only $60,000 down. And your rates drop into the 10.99% to 11.49% range.
And this tier unlocks something else, right?
2 massive features: access to advanced draws and eligibility for those ground-up construction funds.
Oh, wait, let's put a pin in advanced draws for a second. Let's get to the top tier first.
The elite level is platinum tier. This is for investors with 10 or more completed deals under their belt.
The pros.
The pros. They get the absolute lowest rates. From 10.49% to 10.99%, they get all the gold benefits. Plus, they gain access to non-Dutch fix and flip loans.
Okay, we absolutely have to define that. What on earth is a non-Dutch fix and flip loan, and why is it the ultimate prize?
It is the highest form of trust from the lender. In a standard or Dutch fix and flip loan, the lender calculates your interest payments based on the full committed loan amount.
From day one.
From day one, no matter how much you've actually drawn for the purchase or the rehab.
Wait, so if I get approved for $500,000, but I only draw $100,000 this month, I'm paying interest on the whole $500,000.
In a Dutch loan, yes. But a non-Dutch loan means you only pay interest on the money you've actually drawn and have outstanding.
So in that example, I'm only paying interest on the $100,000.
Exactly. And for a sophisticated investor who's managing cash flow across multiple projects, avoiding interest on unused capital translates into thousands of dollars in pure savings. It's a huge competitive advantage.
That is the clearest quantitative reward for proven expertise I've ever heard of. That table of tiers tells you everything about their risk appetite.
They bet on consistency and experience.
Okay, now we know who qualifies for what. Let's dig into the practical mechanics of the funding, the limits on a fix and flip.
Right. For fix and flip projects, the leverage maximums are designed for maximum reach. So you can get up to 90% of the purchase price funded, and it's critical for your cash flow, up to 100% of the rehab costs.
100%.
But we need to introduce 2 more acronyms here to understand the caps: LTC and ARV.
Define those for us.
LTC is loan to cost. It measures the total loan amount against your entire project cost. So, purchase plus rehab, they cap that at 93%.
And ARV?
ARV is the after repair value. It's what the property is expected to be worth when you're done. The total loan can't exceed 75% of that final ARV.
So that's the lender's safety margin.
Exactly. It's their 25% equity cushion, making sure they don't over-leverage the project's eventual worth.
Okay, so let's go back to those advanced draws you mentioned for gold and platinum tiers. How does that cash actually flow?
Advanced draws are, think of them as quick access to project funds, that early cash you need for materials or just to get contractors started.
And they're fast.
Very fast. Usually dispersed within 48 to 72 hours after closing, so you keep that project momentum going.
That speed could literally prevent a contractor from walking off a job. Is there a limit on that?
There is. The maximum amount is the lesser of two figures,
Yeah.
up to 20% of the total project funds or $25,000. It's enough to get the ball rolling.
Okay, here's where we hit a really surprising detail, though. Let's talk about permits. Traditional lenders are often paralyzed without a stack of city permits.
Right.
What did our sources reveal about this?
This detail says so much about their risk assessment. Permits are explicitly not required.
Not required.
As long as the investor is not changing the floor plan or expanding the horizontal footprint of the building.
That is huge. So simple cosmetic renovations, new kitchens, bathrooms, floors, paint can all move forward without the agonizing delays from the city planning department.
It's a massive reduction in friction at the start of a project. Now, if you were changing the scope significantly, like building an addition or moving walls,
Then you need them.
then permits are absolutely required. And at that point, the lender looks at your track record, a detailed scope of work, and your application before they approve the draw schedule.
That flexibility makes HML perfect for those high-velocity cosmetic flips. Okay, what about the maximum scale ground-up construction? How does the LTV work when you're just starting with a patch of dirt?
So GUC financing ties the LTV directly to the land status, which reflects the risk. If the land is unpermitted, the leverage is cautious, up to 65% LTV.
Makes sense.
But if the land is already permitted and ready to go, the LTV jumps to 75%. And even with raw land, the overall caps are still aggressive. 93% LTC and 75% ARV.
Permitted land is just a more liquid, lower-risk asset because those bureaucratic hurdles are cleared. Okay, let's transition now. Strategies for accessing equity after you buy something. We need to talk about refinancing and the rules around seasoning.
Seasoning is the gatekeeper. It's all about how long you've owned the asset.
And the first move is something called the delayed purchase.
This is for the investor who finds that screaming deal that needs an all-cash close, like right now. The rule lets them pay cash for a property and then place financing on it within 6 months to pull that equity right back out.
Wait. So I can find a property, pay cash on a Tuesday, and potentially refinance it by Friday
Potentially.
and get almost all my capital back, up to 90% LTV, without waiting for the normal seasoning period.
That is the power of the delayed purchase rule. It's incredibly powerful for investors with high cash reserves. It lets them cycle that capital through deals very, very quickly.
But once you pass that 6-month window, the rules change.
Dramatically. It shows the lender's skepticism about rapid, unproven value increases.
So what does it look like between 6 and 12 months of ownership?
In that 6 to 12-month window, the loan is treated as a refi, but, and this is key, it is subject to the original purchase price only. The lender is basically saying, we don't trust any new appraisals yet, and the LTV restrictions by tier become very restrictive.
So lay out that penalty structure for us.
This really shows the cost of being inexperienced and trying to pull cash out too quickly. Bronze tier investors, they are not eligible to refi in this window at all.
Not at all. Wow.
Silver tier faces a harsh 15% leverage deduction, capping them at 65% LTV.
And gold and platinum.
With their track records, they face a less punitive 10% deduction, capping them at 80% LTV.
That is a fascinating psychological move. The lender is telling the silver tier investor, we don't trust your ability to add value this fast, so you have to leave a lot more of your own cash in the deal.
It's enforcing a cautious risk profile. If you want to use the new as-is value of the property for your refinance, you have to wait until the 12-month mark.
And what happens after that full year?
After 12 months, the new as-is value is used. But those same LTV deductions by tier still apply. And the crucial caveat here is that for these 12-plus month loans, permitted work is required.
So you need the paper trail.
You have to be able to show verified structural improvements that justify the new higher valuation, or the loan might be denied.
So that gives you, the investor, a crystal clear roadmap. Either move instantly with a delayed purchase or wait a full year and make sure your value add is documented.
It creates a predictable structure.
Okay, let's pivot for our final section here, the local context. Why do these specialized tools matter so much in the San Diego market specifically?
Well, San Diego, America's finest city, is a real estate pressure cooker. You have world-class demand from 70 miles of coastline, the energy of the gas lamp quarter.
I mean, the high-wage jobs.
A massive hub for biotech, military tech, and major institutions like UC San Diego. It's a high-demand, high-cost market where inventory moves incredibly fast.
And when every asset is expensive, that ability to maximize leverage, getting to 90% LTV instead of 80%, that's absolutely critical.
It is.
That 10% isn't just $50,000. It's the difference between being able to secure a second or third property.
Absolutely. And the sources are clear that local market expertise is non-negotiable for these lenders. They don't just lend broadly. They specialize down to the neighborhood. They list areas like Chula Vista, Oceanside, Escondido, Carlsbad, and then specific city neighborhoods like North Park, La Jolla, and Mission Beach.
That local knowledge must give them more confidence in the asset.
It's what translates into the remarkable flexibility they offer.
So if we step back and summarize the core value proposition for you, the investor, looking at this market, what's the key takeaway?
The core value is the combination. It's the specialized loan products like DSCR and bank statement loans solving major qualification hurdles,
Right.
combined with that reward structure, the 4 tiers, that financially rewards your experience. And it's all delivered with that unmatched commitment to speed, that 14-day close.
Efficiency, leverage, and trust.
That's what they're selling.
That wraps up our deep dive into these HML sources. We've covered everything from the mechanics of a non-permitted rehab loan to the huge reward of reaching platinum status.
So to leave you with a final thought to mull over, consider those borrower tiers and the LTVs we detailed. The lender's ability to fund the highest percentage of a project-high LTV, 100% rehab, is a direct measure of trust in you to execute.
Right.
We saw that a platinum borrower with 10-plus deals gets a full 10% higher max LTV than a bronze borrower with only 1 or 2 deals. So think about what those 8 extra completed deals truly represent in terms of mitigating risk, managing unexpected costs, and meeting deadlines. That justifies a lender betting an extra $60,000 on the platinum investor on the exact same $600,000 house. It's a powerful lesson in the real hard cash value of a track record.